There is a right amount of money to keep in your checking account. That part is true. Almost every video you have seen on this is correct about that and wrong about everything after it. Because they will tell you the danger is the government watching your balance, there is no limit. There is no law. There is no number at which the Internal Revenue Service starts looking at what sits in your account, and anybody who told you otherwise was guessing. But the number is real. 3 things said it, and not one of them works for the government. I want to start by taking that fear seriously instead of feeding it, because I think you have been fed enough. If you have been told there is a threshold in your checking account that puts you on a list, I understand exactly why that landed. There is a real reporting rule in this country, and it involves a real number, and that rule is about cash moving across a counter. It has never been about what your balance is. Your bank is not filing anything because you keep a cushion. Nobody is scoring you for being careful with money. And I want to be blunt about why that matters, because it is not just a correction. It is the whole reason people lose money on this subject. When you are told the villain is the government, you do one thing. You get nervous, you move some money around, maybe you take some out, and then you feel like you handled it. And the actual problem is still sitting exactly where it was, doing exactly what it was doing, because it was never about the government at all. The fear points you at a door that is closed. Meanwhile, 3 windows are open and nobody mentioned them. So here is what this video actually is. There is a correct amount of money to keep in your checking account, and it is a specific number, and I am going to hand it to you before the end. But the 3 things that set it are your own bank, a gap in federal consumer protection law that most people have never heard of, and a fact about what happens to that specific account when you die. Every one of those 3 is taking something from you this month, not in some future year, this month. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because the first of these 3 is running against roughly every household in this country, and the fix takes 1 phone call. Let me start with the one that costs you cash every single month. Reason number 1 that your balance is too high is that your own bank is paying somebody else more than it is paying you in the same building today. I need you to understand this properly because most people hear this and think it is a complaint about low interest rates. It is not. Rates are not low. As of right now, the national average on a savings account in this country is about 1/3 of 1%. Many of the largest banks in America pay 1/100th of 1%. That is not a typo, and it is not an exaggeration. On $10,000, that is roughly $1 a year, and a lot of standard checking accounts pay nothing whatsoever. Meanwhile, the best available savings rates in this country right now are around 4%. Fully insured. Same protection, same government backing, same guarantee. Now here's the part almost nobody explains. That is not a story about big banks versus little banks, or about you being at the wrong institution. In an enormous number of cases, the same institution offers both. The bank you have used for 30 years has a product paying a fraction of a percent, which is the one you are in, and a differently named product paying several times that, which is the one they advertise to people who do not bank with them yet. There is a name for this inside the industry. The money already sitting with them is the back book. The money they are trying to attract is the front book, and the entire business model is that the back book does not move. Your loyalty is not being rewarded, it is being priced. That is the sentence I most want you to sit with. You are not earning a low rate because rates are low. You are earning a low rate because you have not asked, and the entire system is built on the calculation that you will not. Let me show you what that costs on ordinary money. Take $40,000, which is not a fortune, and which is roughly what a careful retired household keeps between checking and an old savings account at the same bank. At 1/3 of 1%, that earns about $150 a year. At 4%, that same $40,000 earns about $1,600 a year. The difference is close to $1,450 annually, every year, on money you already have, in an account that is already insured, with no risk added, no market exposure, and no lockup. That is a property tax bill. That is a Medicare supplement premium for several months. That is a genuinely meaningful amount of money to a household on a fixed income. And it is not being taken by inflation, or by the government, or by anybody you could be angry at in a satisfying way. It is simply not being paid to you. Let me tell you about Roscoe. Roscoe is 72. He lives outside Dubuque, Iowa. He was a machinist for 34 years. He has banked at the same place since his kids were small, and he likes it there. And he knows the woman at the counter by name, and she asks about his knee. He had a little under $60,000 sitting between a checking account and an old savings account at that bank. Not because he was unsophisticated, because he had decided years ago that he did not want to think about money, and that keeping it simple was worth something to him. And he is not wrong about that. When his grandson finally sat down and looked at the statements with him, the savings account was paying 1/100th of 1%. That same bank was running an advertisement in the window for a savings product paying more than 3.5%. Same bank, same lobby. He could see the sign from where he stood. He had lost somewhere north of $10,000 in interest over the previous 5 years by being in the wrong product at his own bank that he could have moved into with one conversation at a counter he stood at twice a month. And I want to be careful about how I describe what happened to him, because it would be easy to tell this story as though somebody cheated him, and that is not what happened. Nobody at that bank lied to Roscoe. Nobody hid anything. The rate on his account was printed on his statement every month, in a small line near the bottom that he had stopped seeing sometime around 2010. The better product was advertised in the window, in public, to everyone, including him. There was no deception anywhere in it. There was only the absence of a single sentence. Nobody at that institution ever said, "Roscoe, the account you are in is not our best account. Would you like our best account?" And they were never required to. That is the entire thing, not fraud. A sentence that nobody had to say and that nobody said. And I think that is why this particular loss is so widespread, and why it is so much larger in total than most of the things people worry about. Fraud is dramatic and rare. This is boring and nearly universal. There is no moment, there is no letter, there is no day it happened. There is just 5 years, and a difference between two numbers that were both available the whole time. Roscoe was not careless. He was loyal, and loyalty is the exact behavior the pricing is built around. Now, that is exactly the kind of thing I built the quiet rules for. Not because Roscoe needed a financial expert. He needed one page, telling him what to ask and who to ask it. That is what this is. It is written large, in plain English, and it is a list of the questions that decide what happens to your money, in the order you need them, so the person standing at a bank counter already knows what to say instead of working it out 5 years later with a grandson and a stack of statements. You can find it at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. So let me ask you something before we go on. When was the last time you actually looked at what your money is earning? Not what your balance is, what the rate is. If you cannot answer that, that is the whole reason I made this section. Now let me deal with the objections, because I know exactly what some of you are thinking, and I think both objections are reasonable. The first is that 4% sounds like it must involve risk. It does not have to. A savings account at a federally insured institution is a savings account at a federally insured institution. The insurance is identical whether the rate is 1/100th of 1% or 4%. There is no version of this where the higher rate is less protected. The rate is a business decision by the bank, not a measure of danger. The second objection is the real one, and I have more sympathy for it. Some of you do not want an online bank. You want a building. You want a person. You want somewhere to walk into when something goes wrong. I understand that completely, and I am not going to talk you out of it. So here is the version of this that requires you to change nothing at all. Call your own bank or walk in and ask them one question. What is your highest paying savings or money market product that I qualify for, and what rate is it paying today? Not, what am I earning? What is your best? Those are two different questions, and they produce two different answers. A great many of you will find out there is a better product sitting inside the institution you already trust, that you can move into without leaving, without a new relationship, without learning anything, in about 15 minutes at the counter where they already know your name. And if they tell you their best is a fraction of a percent, then at least you know, and you can decide what to do about it with actual information, instead of a vague feeling that you should probably look into that sometime. Now, reason number 2, your balance is too high, and this one is not about money you are losing slowly. This one is about money that can leave in an afternoon. The account with the most money in it is the account with the most doors. Think about what is actually attached to your checking account. A debit card in your wallet. paper checks with your routing number printed across the bottom, online banking with a password, a mobile app, automatic payments going out, direct deposits coming in, and for a great many of you now, an instant transfer service built right into that app, whether you have ever used it or not. Every one of those is a way in, and they all lead to the same pile. Your certificate of deposit does not have a debit card. Your retirement account cannot be drained with a phone call on a Sunday. The savings account at a different institution has no checks attached to it. Checking is the only account in your life that is deliberately designed to be easy to get money out of, quickly, from anywhere, by several different methods. Which means the amount in checking is not just a balance. It is the size of the worst possible afternoon. And here is the part that made me angry when I went through it properly, because I think most people watching this genuinely do not know it. There is a federal regulation that protects you when money leaves your account without your permission. If somebody steals your card or gets into your online banking and moves money out, that is an unauthorized transfer, and there are real protections and real timelines, and the bank generally has to make you whole. But there is a line running straight through the middle of that protection, and the line is not about whether you were robbed. It is about whose finger hit the button. If somebody tricks you into sending the money yourself, that is generally treated as an authorized transfer. You approved it. It does not matter that you were lied to. It does not matter that the person on the phone said they were from your bank's fraud department, or from the government, or from a utility company about to shut off your power. Under the regulation as it is currently applied, the protection that covers a stolen card does not automatically cover a person who was deceived, and banks have used that distinction to deny an enormous number of claims. A Senate investigation into one of the major instant transfer networks found that across a large sample of cases, the participating banks reimbursed less than half of the money that was taken. There has been movement. Since a policy change a few years ago, participating institutions do reimburse victims of certain impersonation scams, where somebody pretended to be the bank itself. That is real, and it matters. But it is a narrow category, and it is policy rather than a guarantee, and outside of it, you are largely on your own. Now, I want to explain why this hits older households harder than anybody else, because it is not the reason people assume. It is not that older people are more gullible. I do not believe that, and the evidence does not really support it either. What is actually true is much simpler and much more mechanical. Older households tend to have everything in one place. That is not a character flaw. It is the completely rational result of 50 years of being told to keep things simple, plus a lifetime of doing business with institutions where the same person handled everything, plus the entirely reasonable preference not to manage 6 accounts at 79 years old. So when the money is all in one account, the exposure is all in one account. It is arithmetic, not judgment. The second thing is speed, and this is the part that changed underneath everybody without any announcement. A generation ago, money moved slowly, on purpose. A check took days to clear. A wire required a visit. There was friction in the system, and that friction was, without anyone intending it, a protection. It gave a person time to think, time to mention it to a daughter, time for the feeling in the stomach to arrive before the money was gone. That friction has been removed, almost all of it. Instant transfer means instant, and instant means that by the time you say the sentence out loud to somebody who loves you, the money has already been moved out of the receiving account by a person who does this professionally. So we took away the delay that used to save people, and we did not replace it with anything. And the third thing is the one nobody wants to say plainly, so I will. These calls are not random. There are lists, and the lists are targeted, and a household that has been at the same address and the same phone number for 30 years is easy to identify and easy to reach. None of that is a reason to be frightened of your telephone. It is a reason to make sure that the thing at the end of the phone line is not everything you own. Let me tell you about Eva. Eva is 78. She lives in Sedalia, Missouri. Her husband handled the money for 51 years, and then he died, and she learned all of it at 74, and she learned it well. She reconciles her statement every month with a pencil. In March, a man called her. He knew her bank. He knew the last 4 digits of her card, which is not hard to obtain, and which is the single most effective thing a person can say to make you believe them. He told her there had been an attempted charge in another state, and that the fraud department was moving her funds to a protected account while they issued a new card. He stayed on the phone with her for 51 minutes. He was patient and kind. He never once asked for her password, which she had been warned about, and which is exactly why she believed him. He walked her through sending the money herself through the transfer service in her own banking app in 3 transactions to what he told her was her own protected account. $22,000. That was everything in checking, because everything was in checking. Her Social Security landed there. Her small pension landed there. The proceeds from selling her husband's truck 2 years ago had gone in there and never left. She called the bank 90 minutes later, the moment her daughter said the words out loud. And here is what she was told, and it is what most people in her position get told. She had authorized the transfers. The money had already moved. It was gone from the receiving account within minutes, which is how that always works. And her claim went into a process. She got part of it back, eventually, after months, after her daughter escalated it twice, and after they filed a complaint with the Federal Consumer Bureau. Not all of it. And I want to say the thing that I think matters most here, because it is not the part people expect. Eva did not lose that money because she was foolish. She was a woman who balanced a checkbook by hand every month. She lost it because a professional spent 51 minutes on the telephone doing the only job he has, and because everything she owned was sitting in the one account he could reach. If she had kept $4,000 in checking and the rest somewhere separate, the same phone call happens, the same man is just as convincing, the same 51 minutes go by, and the loss is $4,000 instead of $22,000. And the difference between those two numbers is not intelligence or vigilance. It is architecture. That is the whole idea behind the guide. It is not about being clever. It is about arranging things beforehand so that a bad afternoon has a ceiling on it. Same place, kevinexplains.shop, link in the description, pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no questions, no argument. Picture the kitchen table, the phone still warm, the daughter standing there, and the number on the screen that used to be everything. So here is the rule that comes out of this one, and I want you to hear it as a number, not a feeling. Keep in checking only what you could lose in a single afternoon and still eat. That is the test. Not what feels comfortable, not what makes the balance look reassuring. What could disappear between lunch and dinner without ending you. For most retired households, that is 1 month of expenses plus a small cushion. If you spend $3,000 a month, that is somewhere around $4,000. If you spend $5,000 a month, that is somewhere around $6,000 or $7,000. Everything above that line belongs somewhere with fewer doors on it. A separate savings account, ideally at a different institution, with no debit card attached, no checks attached, and no instant transfer service enabled. And while you are there, 3 things that cost you nothing and take an afternoon. Turn on alerts for every transaction over a threshold you pick. Every bank offers it. Almost nobody uses it. A text message the moment money moves is the cheapest security in existence. Ask your bank to add a trusted contact to your accounts. That person gets no access and no authority over a single dollar. They are simply somebody the bank is allowed to call if something looks strange. It converts a bank that has to guess about you into a bank that can check. And make one promise to yourself right now, out loud if you have to. No legitimate institution on earth will ever ask you to move your own money to keep it safe. Not your bank, not the fraud department, not the government. Nobody. If somebody on a telephone asks you to transfer your money anywhere, the call is a crime in progress, and you may hang up without being polite about it. Now, reason number 3. And this one does not cost you anything while you are alive, which is exactly why nobody has ever mentioned it to you. Your checking account is almost certainly the only account you own with no instructions on it. Think about the rest of your financial life. Your retirement account has a named beneficiary because they made you fill that out on day 1. Your life insurance has a named beneficiary because that is the entire point of it. Your certificates of deposit probably have one. Even your pension has a survivor election attached to it. Now, who is the beneficiary on your checking account? Most people cannot answer that, and the reason is simple. There usually is not one. Nobody ever asked you. When you opened that account, possibly decades ago, nobody sat you down and said, this is an asset and it needs a destination. It was a place to put the paycheck. It has never been treated as an asset by anybody, including you. And then a person dies and it turns out to be one. Here is what happens. An account with a named beneficiary passes directly to that person. They bring a death certificate and identification, and the money is theirs, generally within days. It does not wait for anything. An account with no beneficiary and no joint owner goes into the estate, and the estate goes through a court process. And that process takes months, sometimes many months, before anybody has legal authority to touch a dollar of it. So the account with the most everyday money in it, the one the family will need in week 1, is very often the only account in the whole picture that nobody can reach in week 1. And I want to name the week I am talking about, because this is not abstract. The funeral home wants a decision within about 48 hours and a substantial deposit. There is a headstone. There may be a final medical bill. And meanwhile, the mortgage payment is still scheduled, and the electricity is still scheduled, and the car insurance is still scheduled, and every one of those is drafting out of an account that is now frozen while a court decides who is allowed to sign. There is one more thing that connects this directly back to your balance, and it is the part that actually gives you a number. Nearly every state has a simplified process for small estates. If the total value of the estate falls under a certain figure, the family can use a much faster and much cheaper procedure instead of the full court process. Sometimes it is a single sworn form. That threshold varies enormously from state to state. In some places, it is quite generous. In others, it is surprisingly low. Which means the balance sitting in your checking account can be the specific thing that pushes an estate over that line and sends your family into the long version of this instead of the short one. Not the house, not the retirement account, which passes by beneficiary anyway, the everyday cash. So the amount you keep in checking is not only about interest, and it is not only about fraud. It can also be the difference between your daughter signing one form in 3 weeks and your daughter hiring a lawyer for 8 months. Let me tell you about Junie. Junie was 79. She lived in Tupelo. She had been widowed a long time, and she was, by every account, the most organized person in her family. She had a will, she had a folder, she had written down where everything was. She had also kept about $31,000 in her checking account, because that was the account she understood, and because after her husband died, she had decided she never wanted to wonder whether the money was there. Her retirement account had a beneficiary, and her son had that money in about 9 days. Her life insurance had a beneficiary, and that paid quickly too. The checking account had nothing on it. Not because she was careless, because in 53 years of having a checking account, not one person at any bank had ever mentioned that it could have a beneficiary at all. Her son paid for the funeral on a credit card, while $31,000 of his mother's money sat in an account he could see on her statements and could not touch. And the fix, the actual fix, is a form that takes about 10 minutes and costs nothing. It is usually called a payable on death designation. You walk into your bank, or you do it online at many of them, and you name a person. That is it. You keep complete control while you are alive. The named person has no access, no authority, and no ability to see anything. They cannot take a dollar. Nothing about your account changes in any way you will ever notice. And on the day it matters, that account stops being a court problem and becomes a form. Ask about it on every account you have. Checking, savings, all of it. And then here's the second half that people skip. Ask what is currently on file, because a designation you made 20 years ago is still doing exactly what you told it to do 20 years ago, regardless of who has died or divorced or fallen out since. And I want to spend one more minute on that second half, because it is where the real damage happens, and almost nobody checks it. A beneficiary designation on an account beats your will. That is the part that surprises people, and it surprises them at the worst possible moment. You can write a will that divides everything evenly among 3 children, sign it in front of a lawyer, keep it in a fireproof box, and if the beneficiary form on an account says one name, that one person receives that account. The will does not override it. The form wins. So a name you wrote down in 1994, in a branch that has since been bought twice, on a form you have no memory of filling out, is currently a legally binding instruction about your money. The most common version of this is a former spouse. The second most common is a person who has since died, which does not simply pass to the next in line the way people assume. It often means the designation fails entirely, and the account goes back into the court process, which is the exact outcome the form existed to prevent. And the third version is the quietest one. 3 children, 1 name on the form, because that was the child living nearby in 1994. That family does not have a legal problem. It has something worse. It has a Thanksgiving problem, permanently, and the person who caused it is not there to explain what they meant. None of that requires a lawyer to fix. It requires you to ask what is on file, and to update it if it is wrong, and to do it on every account rather than the one you happen to think of. And once you have done it, tell somebody. Not the amounts, just which institutions hold accounts and that designations exist. Because a form nobody knows about is only slightly better than no form at all. Now let me give you my honest opinion, and it is only that. I think the fear story about the government watching your balance is popular for a very specific reason. It is popular because it does not ask anything of anyone. If the villain is a federal agency, then you are a victim of something enormous and distant, and the emotion is satisfying, and nothing in your life has to change. But if the answer is that your bank is quietly paying you a fraction of what it pays a stranger, and that your everyday account has more doors than any other account you own, and that nobody ever told you the form existed, then somebody has to make 3 phone calls. And phone calls are harder than outrage. I also think there is something worth saying about who benefits from the confusion. Every institution in this chain is behaving legally. The bank is allowed to offer 2 rates. The transfer network is allowed to draw the line where it draws it. Nobody is required to tell you a beneficiary form exists. But notice that in all 3 cases, the silence pays somebody. It pays the bank to leave your money in the low product. It saves money to define a deceived customer as an authorized one. And nobody anywhere has a financial reason to hand you a beneficiary form for a checking account. So the information does not travel. Not because anyone is lying, but because in a system where nobody is required to speak, silence is free and honesty costs something. That is not a conspiracy. That is just what happens when nobody is assigned the job. All right, here is the number I promised you and then your checklist. The correct amount to keep in your checking account is 1 month of expenses plus a cushion of $1,000 or $2,000. For most retired households in this country, that lands somewhere between $4,000 and $8,000. Not because a threshold exists, not because anybody is watching, because above that number, every extra dollar is earning nothing, sitting behind the most doors, and adding to the pile your family cannot touch first. 3 things this week. 1. Call your own bank and ask what their highest paying savings product is and what rate it pays today. Not what you are earning, what their best is. Move everything above 1 month of expenses into it. 2. Turn on transaction alerts, add a trusted contact, and make sure the account holding the bulk of your money has no debit card, no checks, and no instant transfer enabled. Then say it out loud once. No real institution will ever ask me to move my own money to protect it. 3. Ask your bank for a payable on death form for every account and ask what is currently on file. 10 minutes. Let me leave you with this. Roscoe could see the better rate on a sign in the window of the bank he had used for 30 years. I have balanced her checkbook by hand every month for 51 years and lost everything in one account because everything was in one account. And Junie was the most organized woman in her family and left her son paying for her funeral on a credit card with her money visible on a statement and out of reach. Not one of them was careless. Not one of them was fooled by the government. Every single one of them was simply never told a thing that would have taken 10 minutes to say. That is what this whole subject actually is, not surveillance, not a threshold. 3 ordinary silences, and the only cure is asking out loud. So go ask, this week, while nothing is wrong. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.